Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started.
Welcome to another episode of Kaizen Time. I'm joined by Pierre, Senior Manager and Mentor. Pierre, I got a question for you.
Sure.
What is an S-Corp? I know we brought it up before, but a lot of people ask this because they have no idea. So what is it, and why should you even consider being one?
Great question. So S corporations are C corporations that have elected to be taxed as S corporations. So what does that mean? So it's a corporation. Corporation, you understand, is a separate entity. It is a business that does some type of activity, generally for profit, hopefully. And that the difference between a C Corp and an S Corp is an S Corp, while it does file a tax return, it doesn't pay its own tax. It passes through all the income to the owner on what people call a K-1. This is very similar to a partnership. Partnership is also a separate entity, but doesn't pay its own tax. It files a tax return, but doesn't pay it. It passes it through to the owner, the shareholders, or the partners, and they put it on their tax return. So now you're saying, gosh, those sound like you said the same thing, right? And I did. They both pass through the income, but then there are different benefits of each one. So when you talk about what it is, an S corporation can have has some rules that you have to follow to be an S corporation. So, and if you break one of those rules, you get reverted back to a C corporation. C corporation pays its own tax at the corporate level. If you take any money out of that company, you pay tax again. That's the double taxation they're talking about.
Okay.
Partnerships and S corps only pay the tax once, unless you make a mistake. One of those mistakes would be like the built-in gains tax. If you convert to an S corp and then sell it, you will pay tax twice because you didn't wait long enough. But generally, S corp and LLC lets you pass through the income to you personally. Again, Pierre, that sounds like you're saying the same thing.
It does.
I am. The difference is partnerships have some rules, S corps have other rules. S corps, you have to take income and ownership, income out of the company in the same ratio as the ownership. So if you and I own 50-50, if I take a distribution, you have to take the same distribution.
Oh, right? Interesting.
A partnership can mess around with that. You can say, Pierre, I'm doing well right now. You're struggling. You're a terrible accountant. You need more money. You take 85% of the revenue each year. I'll take 25%, and we'll straighten it up down the road. You can't do that in S corp. If you do that in S corp, you've created a second class of stock, but you can only have one class of stock, and you would thereby eliminate your S corp, and now you've made yourself a C corp again. Partnership can move stuff around. Another thing, a partnership, you do have to reconcile at some point, because you're going to be like, hey, wait a minute, you took an extra 35% every year.
Let me clarify, though. Let's say we're in an S-Corp. We'd have to do it 50-50.
Yes, whatever our ownership is. If you were 25 and I was 75, I would take 75, you would take 25.
Gotcha.
If we had 5 partners, one was 10, 10, 10, 10, and 60, right? We would take it out in that ratio. Partnerships, you can have 10 partners and people take different amounts. It's just when you go to sell, you have to reconcile those variances. S corp will destroy the S corp. Subtle thing. So
an S corp's a one-way trip, right?
Yeah.
You can go there, but you can't go back.
No, if you go S corp, you can get kicked out of S corp. You can elect to go back to C corp, but you have to ask for permission to do that or make a mistake.
There are rules.
Yeah. So, but generally you don't want to. But why would you do an S corp versus a partnership? Because so far I keep saying they're very similar, except for that distribution part. The other thing with a partnership or an LLC is whatever income, you're not supposed to pay the owner's salary. Whatever the net income of that company is your earnings, and then you pay payroll tax on that whole amount. So if you make $100,000, we pay payroll tax on that $100,000. On an S corp, you can pay payroll to the owner. You can pay payroll to the owner for the job that they do doing the work, and then you can take the rest out as the owner. I like to call it you and your grandma down in Florida that gave you money to start the company. But she's part owner, but she's not turning wrenches, doing taxes.
She's practically an investor.
Yes, she is, but she wants to be part owner. So She put up the money for it. She doesn't work there, but you work there. So in a partnership, you would each get 50-50 of the partnership income. You could take distributions at a different amount, but you would pay payroll tax on the whole thing.
Okay.
S-Corp, same partnership that you own with grandma's 50%. She pays no payroll tax on because she doesn't work there. You pay payroll tax on your wages for your job, your rent,
you are working
your tax
there.
because you're working there, active participation. And then the rest of the income comes out as dividend, and you only get taxed once, and you don't pay payroll tax on it.
Pierre, I think it's going to help a lot of people if we go through what are some very common businesses that are like ideal for an S-Corp.
So any operating business that you work at, that you're participating in, should be an S-Corp. Yeah.
That you're physically doing it as the owner.
Correct. Now, a lot of lawyers, every lawyer, wants you to be an LLC because they say that they can protect you better as a partnership.
Because it's a limited liability
corporation. So now as I'm really talking about three things. LLC and partnership are nearly identical. They're slightly different.
All these sound really identical.
And then an S-Corp is that other difference. All of them pass through to the personal. All right. They file a tax return, but they don't pay their tax. That being said, some states make you pay some state tax, especially after the income limitation of state tax. We are allowed to do pass-through entity tax. But aside from that, what you're talking about is the income from this is all self-employment income, and this you can break it up. That's the key difference. So most lawyers will set up your company as an LLC. I'm an LLC. My other guy's an LLC. You said LLC. An LLC can elect to be taxed as an S-Corp and still maintain their status as an LLC for liability purposes. So you'll see that a lot. But when you become an S-Corp, now you can pay payroll. Now you can say, hey, the job you're doing there, you're not very good wrench turner. We're only paying you $25,000. $75,000 is you as the owner, doing all the other stuff, planning, buying buildings, hiring people. But as the wrench turner, Steve over there is much better. We pay him more, but you have to have fair and reasonable compensation, right? So generally you don't get paid. You shouldn't be paid the least as the owner of the company unless you're really not doing anything. That sounds wrong. You're not doing the act of participation as much. You may be running the business, having meetings with grandma down in Florida, doing management activities, but not actively participating in the work.
I mean, a great example is, hey, I'm going to take half the year off and do blah, blah, blah. I'm going to hang out with grandma in Florida, right? And let the business run itself. That's a situation where you're like, your salary should go down because you aren't actively participating.
Yes, but you are still doing something. So you can't have your salary. We generally think if you're going to be in there, your salary should be at least $80,000. And that's one thing. If you're not making that much money, you might not need to be an S-Corp versus an LLC. Because
is there a point where you say this number or this number of employees, give me a snapshot where they should make that transition?
So number of employees doesn't matter because partnership can have employees. It just can't be you. Right. So if you're a single member person just doing it, you're making wooden ducks, right? You're carving them and you're doing that. And your partnership, you have to have a partner to be a partnership, but single member LLC can just file that if you don't have that much activity. You start hiring people, you might think about it. You still have the liability protection in case one of those ducks attracts Godzilla or something and it didn't do what it was supposed to do and you all died from it. That liability will protect you. But going forward, everything that you have coming in will just go through to you personally. All right. And if it's small, I'd say 70 or 80,000 seems to be a magic number. If you're not above that, you probably don't need to, unless you're going to pay yourself payroll. Then you have to be an S-Corp.
Okay. Right? So under that, like 70, 80K, keep it an LLC. Feel pretty good about that.
So, and that minimum wage for a year is like $25,000. If you're going to cut that corner and go down that, I wouldn't go below that. But unless you're grandma and you definitely never come into the shop, don't do anything there.
Do not turn that wrench.
Do not turn that wrench at all. And that's one of the biggest things because it is more complicated to have payroll. You do have to file a separate return. You might have to pay the state tax on it. Sometimes partnerships and single member LLCs don't file a separate return.
Okay.
So it adds complexity. But if you can save, so take the example of $100,000 of income on a partnership. That partnership would flow through to you and I as $50,000 and $50,000. We would pay 15% payroll tax on that, right? Which is 7.625 for the employee and the employer half. So 100,000 is really easy to do the math. That means we pay payroll tax of $15,000 on that $100,000 in this partnership. Okay. Net income passes through at the end. We each get a $50,000 K1. It goes on our books. We pay payroll tax on that dollar. Same company, same everything, except this year we're an S-Corp. And in this year, we pay you $25,000 in salary and me $25,000 in salary, right? So $50,000 in salary. The rest we take out as dividend. And we pay income tax on both $100,000, the total $100,000, but we only pay payroll tax on $50,000. That little move, for that simple example, saves you half of that payroll tax. $7,500 for just making that switch.
So reality is, if you can plan it and plan it correctly, you could be saving tens of thousands of dollars per year in just taxes.
Yes. So then you say, well, who should be a partnership? Obviously, if you're small enough and you don't need it, you still get that protection. But what we like in partnerships are non-active participation, such as real estate rentals. Real estate rentals are great for just having as an LLC or a partnership.
Okay.
Two things make it great. You don't have to pay payroll tax. You're not subject to self-employment tax because it's a passive activity by definition. Real estate activities are passive activity unless you're a real estate professional.
Like an agent.
Yes.
Okay.
And that's your primary business. Okay. You can't be 100% real estate agent and president of the United States. That doesn't make sense.
Okay.
So, but most of the times, passive activity, LLC, partnerships have a lot of ability to move stuff around. Where I said you could take different distributions, you could take that building out of this partnership and put it in another partnership without tax consequence. You have to follow the rules. If you put the building in your S-Corp and you go to sell it or move it or switch it or put it into a partnership, that's a taxable event out of the S-Corp. So there are some things to...
And I'll just say, so this is a situation where talk to your accountant before you even try doing this.
Yes.
If you come in an LLC, you have some flexibility to do these things, but make sure it's all squared away before you make that change to an S-Corp.
I mean, you can do whatever you want, but some things have tax consequences.
Yeah. So let's talk about this because I actually have a strange situation that's with an auto shop. So I go to this auto shop, okay? And now there's another one just down the road with almost the same exact name.
Oh.
I shouldn't say almost the exact same. They do actually have the same name. They have different logos, which is very strange. Yeah. And they have different pricing structures. Okay. So to get an oil change at one of them is $10 more than to get the oil change at the other one, which I thought was weird. So let's talk about this from a little bit different perspective. An auto shop. Okay. Let's say it started out as one auto shop, maybe an LLC, just to get going. But, auto shops make a lot of money. They're making millions pretty quickly. What structure would they go into? Like, would you recommend to them? So
you're saying the same owner owns both of these shops?
The head owner owns both, but they compete for business.
Oh, okay.
They are their own individual shop. What does that kind of look like from a tax standpoint?
That looks like a franchise to me, but
there are multiple shops, but there are two within the same town on the same street near each other, but there are like 5 other auto shops that this person would own. They all have the same name, so it is like a franchise.
Yeah.
What do you think?
And so
if you were to do this to set up the taxes,
what would be the advantage of this?
Yeah.
So one of the things you talk about is going to get a little more complicated because you might have a series LLC or a series of sub-owned shops so that you can combine the losses from one to the other. All right. So say one shop is doing bad, poorly,
but the others can
the other's
offset
doing
it.
great. You want to be able to combine those things on your personal tax return. So if you have, if he's not participating, like there's a lot of things that can go wrong here. So if he's not participating, it's a passive activity. You cannot use that passive activity loss against your S-Corp or your other non-passive activity income.
So you better go to that location and turn some wrenches.
Yeah, you better go there and turn some wrenches here. So it's never as black and white as you're asking right now. You have to look at the facts and circumstances. But generally, why wouldn't you put, I like to see each location maybe have its own S-Corp, but then each location has to file its own tax return. Let's file one tax return, but then if something happens here, you might lose everything.
So one of those locations, in theory, could drag them all down.
Somebody slips and falls over here. Now they can attach all your other 5 entities depending on your structure. This is really a legal issue that have your lawyer say we have to have protection. But I like to have separate. I like to have the building in a separate entity than the business, right? If my duck that attracted Godzilla killed everybody, they can take the duck business, but they can't take the building it was in. Hopefully Godzilla didn't step on it either, right? So it's all about protection and liability. But as we've talked about many times here, it's having the knowledge before you make that decision.
Interesting. Now, I just want to run through a few quick things just to, again, give people a snapshot, because I'm sure you've noticed that there are like trends. For example, an accounting firm, they're typically partners.
Yes. Well, okay, so legal firms have to be a PC, and you have to be an accounting firm. If you have CPAs, you have to have CPAs there, right? It's like you and I can't open a doctor's office because we're not doctors, right?
Correct.
But we could run a clinic and hire doctors. But there are different levels of professionalism protect you for accounting and the rules for that particular profession. So the trend for accounting firms to be partnerships is driven by those rules. So what are some of the other trends? You see a lot of investment, private equity companies that are buying restaurants. Last week, that place was owned by a family. Now it's owned by a group that owns a whole bunch of restaurants around.
So it's like a franchise.
Yeah. So they might have been a Schedule C, like a sole proprietorship. And now it's some huge conglomerate franchise. I don't know what the structure is. Could be a C corporation.
Okay. What about something like a chiropractor?
Chiropractors? There was a trend a couple of years ago. There were a lot of chiropractors were being bought up by the same thing. Private equity groups trying to buy chiropractors. However, you have to be a chiropractor to be a chiropractor place. But again, they can put it together and hire chiropractors in their shop. Same thing. A lot happened with veterinary clinics. They were getting bought up by private equity funds. They would hire doctors to work in those clinics. But I think because law firms and accountants, you can't put your name on the accounting firm financial statement
unless you have that certification.
You can have an owner with doctors working at the chiropractor or the dentist shop
without
working on your teeth without being a dental owner. You could hire people to come in. And you think about it, the dentist office or the vet clinic, they move doctors around if all of a sudden this clinic is
doing poorly.
No, well, not doing poorly. Super busy. Like all the horses got sick here. And this practice only does dogs, but this one has an equine problem. They had to bring some vets over here to help out. They will rotate doctors in between clinics.
Okay.
All right. And it's the same thing. So if I'm the owner, if I can bring him in as a doctor, I should be able to bring in a whole bunch of other doctors to do the work for me. And I'm not even a doctor. But I can't sign the paperwork for a financial statement or a law firm without being a lawyer or CPA. You can have an accounting practice that just does tax and not have a CPA license. But that's why you see LLP, which is limited liability partnership, you'll see on a lot of, or a PC, which is a professional corporation on law firms and accounting firms.
Pierre, as we wrap this up, what is the number one thing that you want to tell everyone about S-Corps? And if you tell me that they're all kind of the same.
I think most operating businesses should be an S-Corp. It gives you a lot of flexibility. But if you're not making money, why go through all the paperwork and file an extra tax return?
So what I'm essentially hearing is if you hit that kind of 70, 80K space, right? Yeah, and you
Of profit.
Of profit.
Yeah.
Okay. And you have more than yourself as an employee.
Yeah. Having other people as employees is not the problem. It's only you as the employee that's the problem. A partnership can have employees. You just can't be one of them.
Okay.
All right. Cool.
Thank you, Pierre.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.